What's up investors, Sneers here. The Buffett Indicator, one of the best indicators for measuring how high or bubbly the market is at its all-time high, reaching 200% recently, a number that Warren Buffett said will be playing with fire when it approached that back in the dot-com bubble. So what does this indicator mean and how do we measure it? Can we rely on an indicator like that? And why it might actually be different this time, at least for this indicator. Guys, before we begin, I want to remind you I have additional content for the individual investor in the description below, and as always, if you can leave a like for this video, as it helps me a lot with the YouTube algorithm and allows me to create more content for you. And with that said, let's go on with the content. So let's begin with what is the Buffett Indicator, proposed in 2001 by Warren Buffett as the single best measure for where valuation is currently at. Back then it was used to measure the dot-com bubble, that in retrospective was in an obvious bubble. It's calculated by taking the stock market valuation represented by the Wilshire 5000 index divided by the US GDP representing the economy. The idea is to have a simple view on how high the stock market valuation is compared to the real economy. Let's start by talking about the current market valuation according to this indicator. The current valuation is at all-time high of 214%. You can see that now at the graph from advisor perspective. It's so high and obviously much higher than it was in 2000 at the top of the dot-com bubble. And the dot-com bubble was an obvious bubble. So are we in an obvious bubble right now? What gives? We shouldn't be so fast with that. First, we need to normalize the graph. There is a natural upward trend to this ratio. As technology and productivity progresses, companies and people can produce more and thus have higher valuation for the companies with less throughput. So things that used to require 10 people working for a week to accomplish them, using technology today can be accomplished by one person in a day. So that explains the upward trend, the natural upward trend of this ratio. You can see the upward trend right now in this graph from advisor perspective as well. And the guys at advisor perspective also normalize this graph, and you can see it right now. Looking at this normalized graph changes the things a bit. We see that we are not that higher than what we had in the dot-com bubble, but actually we are in a similar place. Yet the dot-com was a bubble, so are we in a similar bubble right now? Not necessarily, and it depends on several other variables. Let's dive into each variable and explain why it's not necessarily a bubble. The first problem with this indicator is that it's no longer the single best indicator as Buffett mentioned before. Buffett himself denounced this indicator a few years back in one of Berkshire annual meetings. One example for that is that the indicator completely missed the 2008 bubble, as you can see in the graph right now. The indicator is so focused on the stock market alone that it completely missed the real estate and the derivatives market that drove the 2008 bubble. I will expand on that issue soon, but the important point is that no one indicator can measure all the complexities of the stock market and the market as a whole to say if there is a bubble or if there isn't a bubble. We usually need multiple indicators covering different parts of the market to assess whether we are in a bubble or even in an expensive market as a whole. Ray Dalio, which is the biggest macro investor in the world, so he's solely focused on that aspect, published recently an article where he shows his 6 indicators for measuring whether the market is high or not. You can see the indicators right now on the screen, and as you can see in the dot-com bubble, all of his indicators measured that we are currently in a bubble. But if you look at today's market, those diverse indicators, some say that we are in a bubble, some say we are completely not in a bubble. So Ray Dalio methods and indicators paint a completely different picture than the absolute picture painted by the Buffett Indicator. Yet it's important to understand what stands behind the Buffett Indicator and why it might fail, so we understand how to measure the markets better. Let's go deeper into that. So the biggest point, as I already mentioned, is that the Buffett Indicator is focused solely on the stock market against the real economy, and it ignores any different asset than the stock market. Specifically important for our current times is that it ignores completely the bond market. Back in the dot-com bubble, we had an interest rate of 6%, whereas now we have an interest rate of 0.25% only. Together with the money printing of the Fed that buys bonds itself and inflation, the bond market currently offers real negative returns. So the bond market is virtually non-existent for most investors right now. All those investors hoping to get at least some return go to the stock market alone. And going into the stock market alone because of the interest rates and the Fed money printing and the inflation, all those aspects are not considered in the Buffett indicator, and it causes the stock market valuation to be higher than bond or any other asset. Having all these aspects skews the results of the indicator, but yet we are in the same level as we were in the dot-com bubble, but in the dot-com bubble we had a 6% interest rate and very lucrative different assets like bonds or any other asset. So even though the indicator says we are in the same level of the dot-com bubble, it isn't as it seems. So now that we established that the indicator isn't as high as it first seems, I want to touch on another point, that the market can be irrational to the high or to the low for extended period of times. So you shouldn't try to time the market. Look at this graph of the Buffett indicator I showed before. If you look at the 50s to the 70s or the 70s to the 90s, you can see that the market was high or low for extended period of times without moving much. And the same thing can happen now too. We can remain at similar height for 10 or 20 years, and if you neglect to get into the market because of the valuation, you might miss out on 10 or 20 years of investing. On the flip side, we might not stay as high. We might have a crash next year, next month. Nobody knows, and it's important to recognize that nobody knows, and trying to time the market is futile. Instead, you should invest in the market in a smart way regardless of how high or low the market is. So what you should do is invest at great companies at a fair price. If you invest in great companies with fair price, and the fair price is important here, you will get great results in the long term. Even if the market will crash next year or next month, you might hurt in the short term as your stock will go down, but if you bought it at a fair price and the company is good, in the long term you get your returns, and that way you won't stay out of the market for extended period of times trying to time it. Granted that as the market is high as it is, it might be more difficult to find such companies. You might find a lot of great companies, but most of them will be not fairly priced to your opinion. They might be too expensive, and that's okay. It will be harder to find companies, but there still might be opportunities, and if there is not an opportunity for you, it's okay to remain in cash for some time. But don't forget to look for opportunities and seize them as they come. Guys, that's it for the video. I hope you enjoyed it. If you enjoyed it, leave a like, and if you want to see more content for the individual investor from me, please hit the subscribe button below. Thank you, and I'll see you next week. Bye bye.